Decoding investment styles. Navigating market conditions with value and growth strategies. Introduction. In the ever-evolving landscape of investments, the choice between different investment styles is akin to selecting the right tool for a complex job. Among the myriad approaches, value and growth investing emerge as stalwarts, each with its unique philosophy and strategy. Understanding how these investment styles perform in varying market conditions is crucial for investors seeking to navigate the dynamic and often unpredictable financial markets. Value investing in the tides of the market. Value investing, pioneered by the legendary Benjamin Graham and later popularized by Warren Buffett, revolves around the principle of identifying undervalued stocks trading below their intrinsic value. This approach hinges on the belief that markets occasionally misprice securities, presenting opportunities for astute investors to uncover hidden gems. In periods of market uncertainty or downturns, value investing tends to shine. When economic headwinds lead to indiscriminate selling and stock prices plummet, value investors are poised to capitalize on the dislocations. The emphasis on fundamental analysis, including metrics like low price to earnings (P/E) ratios and high dividend yields, positions value portfolios to weather market volatility and potentially outperform during recovery phases. Consider the aftermath of a market correction where stock prices across the board experience a decline. A value investor, discerning intrinsic value beneath the temporary market fluctuations, might identify opportunities in fundamentally sound companies trading at attractive valuations. As the market rebounds, these undervalued stocks have the potential for substantial capital appreciation. However, value investing is not without its challenges. During periods of economic expansion and exuberance, growth stocks often outperform value stocks. Additionally, value investors may need to exhibit patience, as the market may take time to recognize the true worth of the undervalued assets they hold. Growth investing. Riding the crest of market optimism. Contrary to value investing, growth investing centers on identifying companies with robust earnings growth potential, often at the forefront of innovation or operating in high-growth industries. Growth investors are willing to pay a premium for stocks with the anticipation that the companies will continue to deliver impressive earnings expansion. In buoyant and optimistic market conditions, growth investing tends to thrive. Technology-driven advancements, shifts in consumer behavior, and expanding markets create fertile ground for companies with the potential for rapid revenue and earnings growth. During such phases, growth stocks often command higher valuations, and investors are willing to overlook traditional valuation metrics like P/E ratios in favor of future growth prospects. For example, consider a scenario where a groundbreaking technology company unveils a revolutionary product. Investors, fueled by excitement about the company's growth potential, may bid up the stock price to levels that appear lofty based on traditional valuation metrics. Growth investors, however, are focused on the company's trajectory and the potential for sustained high growth over the long term. Despite their allure, growth stocks are not immune to market downturns. When economic headwinds emerge, investors may reassess the premium they are willing to pay for growth, leading to corrections in the prices of growth stocks. The high valuations associated with growth investing also introduce a degree of risk, as any failure to meet lofty expectations can result in sharp market corrections. The yin and yang of market conditions. The performance of value and growth investing is often characterized by a yin and yang dynamic, with each style taking the lead in different market conditions. During economic contractions or bear markets, value investing tends to shine as investors seek safety and value in beaten-down stocks. The emphasis on strong balance sheets, consistent earnings, and dividends becomes particularly appealing in times of uncertainty. Conversely, in periods of economic expansion or bull markets, growth investing takes the center stage. The optimism surrounding the potential for outsized earnings growth propels growth stocks to new heights. And investors are willing to pay a premium for companies at the forefront of innovation and disruption. A balanced approach, blending value and growth strategies. Recognizing the cyclical nature of financial markets, astute investors often adopt a balanced approach, incorporating elements of both value and growth strategies in their portfolios. This hybrid strategy, often referred to as a core and satellite approach, seeks to harness the strengths of each style while mitigating their respective weaknesses. For example, a portfolio may have a core allocation to stable, dividend-paying value stocks that provide a cushion during market downturns. Simultaneously, satellite positions in high-growth stocks offer exposure to the potential for significant capital appreciation during favorable market conditions. This balanced approach aims to capture the best of both worlds, providing resilience in turbulent times and participation in market upswings. Conclusion. In the intricate dance of market conditions, value and growth investing emerge as versatile partners, each performing a unique role based on prevailing economic dynamics. Investors, armed with an understanding of the strengths and limitations of each style, can navigate the ebb and flow of financial markets with greater confidence. Whether weathering economic storms with value investing or riding the waves of growth during market upswings, the savvy investor recognizes the importance of adaptability and a well-balanced strategy in building a resilient and rewarding investment portfolio.